Hi there, I'm Daniel from the Real Estate Southwest Florida. Hi, I'm Daniel from the Southwest Florida Real Estate Channel. I'm going to be going over something called a 1031 tax exchange. I'm also going to relate it to something called the capital gains tax exemption, okay? So a 1031 tax exchange, here's what it is. It's a like property exchange. What it means is, first of all, I'm going to take you through the whole thing. If you own a commodity, I don't care what it is, if you own a boat or a car or anything of value, if you own that thing for less than a year, when you sell that thing, if there's no gain, there's nothing here. If you lose, if there's a loss, that's the end of it. But if you sell that item for a gain, that is an example of income. And income in this particular category is going to be taxable at the federal level at 25%. State of Florida is going to have no income tax. So if you buy a share of stock, if you're a day trader, if you buy boats and clean them up and sell them, if you buy cars and clean them up and sell them, if you buy real estate and clean it up and sell it, when you take it and sell it, I don't know if you've watched HGTV, but that's not the way the math works. When you take it and sell it, what happens is the first thing that has to, the first party to be paid is the government, and they are owed 25%. Okay, and so that's the first part of this. Now, if you own a commodity for a year or more, so what we're going to do here is we'll say real estate. You own real estate for 18 months. What happens is when you sell it, there's a 15% capital gains tax which is owed. Now, when you owe that capital gains tax, let's just say that you live in it as your primary residence, or it's your apartment or whatever. I mean, you own an apartment building or whatever it is. You own a strip mall off of 41 over here in Fort Myers. When you sell it, what you owe is a 15% capital gains tax. Now, what you can do is do a like-kind exchange, and what it means is 6 months from closing to closing. So that means you sold this and you bought this. You got 6 months from this closing to that closing. Within that 6 months, if you buy a like-use property of at least the same value, that means you bought it, you had a residence, you own it for 18 months, you take it and you sell it. Within 6 months, you purchase another one, you owe a 15% capital gains tax. But if you purchase the exact same use property, in other words, residential to residential, and you do it within 6 months, closing to closing, that's called a 1031 tax exchange, and the tax is still owed, but it is deferred. In other words, you can claim on your tax statement that even though the tax is owed, you're not going to pay it, and so what you've got there is a tax haven for yourself, okay? So that's called a 1031 tax exchange. You can do that anytime that you owe taxes on a property that's a capital gains tax rather than an income tax, okay? So that's the first part of it. The second part of it is there's something called a capital gains, there's a tax exemption, okay? And the way that it works, this is just federal tax code. I don't know what you thought of Bill Clinton, whatever you thought of him, he got this law passed. So what happens is if you buy a property and you own it as your primary residence, and you own it for 2 years and you live in it as your primary residence for 2 years, what happens is when you sell it, there is no capital gains tax at all. It's unrecognized, okay? So what that means is you buy a property, you live in it as your primary residence for 20 years. When you sell it, there is no capital gains tax at all. Now, it's capped. It's capped at $250,000 if you're single, or $500,000 if you're married. And so if you're not married, find somebody, anybody, and get hitched. There's good money in it. So what happens is, let's say that you own a property as your primary residence, you're married, you live there for 3 years, you take it, you sell it, there's a $200,000 gain. Well, take it and put it in your pocket. You don't have to do any additional thing. You can go buy a yacht for $200,000, do whatever you want to. You can put that money wherever you want to. You do not owe money. There are no taxes on that because it was your principal residence for at least 2 years. Now, in addition to that, what happens is, let's say, for example, that you have a gain of $1 million. So you're married. So you buy a property, it's your primary residence, you live there for 30 years, there's a gain of $1 million. What would happen is when you sell it, you would owe a capital gains tax of 15% on the $500,000 that goes beyond the $500,000 exemption. Now, in that case, you can do a 1031 tax exchange, meaning buying a property within 6 months from this close to that one of at least the same value. In this example, it would have to be at least $1 million, and the same use, it would have to be residential. And if you do that, you can do a 1031 tax exchange and still not pay those capital gains taxes. Now, in addition to that, what you've got is the law actually states that it doesn't have to be your primary residence for the entire time. It has to be 2 out of the previous 5 years. Think about it for just a second. How many 2's are in the number 5? So let's say, so there's 2 of them, right? So let's say you buy 2 properties today. 2 properties, okay? Move into one, rent out the other one. Do that for 2 years. After that 2 years, flip them. In other words, rent out now the other one, the one you were living in, and move into the one that was rented out. Do that for 2 years. In the 5th year, sell them both, no capital gains taxes owed on either. If you're single, for up to $250,000 per property, and if you're married, for up to $500,000 in gain per property. That is the 1031 capital gains tax. I'm sorry, the 1031, I did the whole thing and then I screwed it up at the end. It is both the 1031 tax exchange and the capital gains tax exemption.